We're all definitely thinking about the elections. It's a big election. It's a very close election. But I'll make a couple of points. The presidency is clearly extremely important, but Congress is very important to get a lot of things done, or not done, because the 2017 tax cuts are likely to expire if Congress doesn't do anything. So beyond the presidency, we're looking at the Senate races, the House races. So the entirety of the election is going to be important. Secondly, there's a lot of policies that are up in the air, right from tariff, immigration, regulation. I talked about taxes, spending. I think it may be a little simplistic to say that one outcome is necessarily good for the economy or good for markets. I think we also have this deficit issue, which is out there.
For either of them.
For either of them, exactly. Whether it's spending or it's taxes or tariffs, they all have fiscal implications. I mean, what I'll say is, as I manage our portfolio, is we're not positioned for one way or the other. It really, from a risk-reward standpoint, given that the election is won by not a lot, 40,000 votes or 100,000 votes, we're talking not about, a very clear divide here. So I would say it's best not to position before the election, to see the election outcome, and then to see what policies are prioritized. Is it going to be taxes first? Is it tariffs first, which is going to have a very different implication? There's also, so I would say when we look at the election and the outcome on markets, I look at the impact on growth and inflation. I look at the impact on the deficit. And then what I really hope is Fed independence remains, but that is, I don't think we should take that for granted. Is there any impact there? Because that's going to have an impact on treasuries as a safe haven, the dollar as a safe haven. These are all things which require an independent central bank. So there's a lot, but I would say...
You really did say Fed independence. You really are concerned.
I am a little concerned.
Wow.
I mean, we've seen this little bit before, and I think now with the fact that, the Fed was late in hiking rates, are they going to be late in cutting rates? They're about to embark on a cutting cycle. And if we have the president or Congress talk too much about Fed policy, it's not great to inspire confidence in the U.S. capital markets. And we need foreign investments. And as the Fed cut rates, I actually think foreigners will look at U.S. fixed income. They'll look at the U.S. equity market. So I do hope that Fed independence remains. I think it's something we should keep at the back of our mind as we think about market implications of the election.
So the Fed has taken rates high enough that money market funds are yielding over 5%. They now stand over $6 trillion. That's a lot of money. What happens as the Fed begins to cut rates? Where does that capital go looking for yield?
Sure. And that's the question I would say every asset management person, every wealth manager is salivating at the thought of that 6 trillion. Historically, that money does move. Once the Fed starts to cut rates, it starts to move first into fixed income and then into risky assets. But here's the catch. We're in a soft landing, and soft landing rate cuts are rare. So can we apply the historically, the Fed is cutting in a recession. So the money moves into fixed income because, well, equities might look a little scary. This time round, if the soft landing is maintained, and that's an if, I think there's a case we're in a good spot. If the Fed was to cut rates quickly enough, we might stay in that soft landing. We have a chance. It's a narrow path, but I think there's a chance we stay there. I think that money moves into different asset classes. Not all of it. There is a reason people own cash, liquidity, cash management. But a certain portion of it, especially as you realize that there's reinvestment risk, that money is not going to stay at 5% as the Fed cut rates, and forwards are arguing for a little below 3%. That cash is going to give you 3% as people start to internalize that. And I think the Fed cutting starts that money then in a soft landing moves into equities, credit, and government bonds. If the economy slows down, I think you're going to see more into fixed income. So there's a bit of a bifurcated outlook for that money depending on how the economy evolves from here.
So it's interesting, when the Fed was raising, so longer duration bonds get a little bit punished. 2022 was a tough year. If the Fed is starting on a longer cycle of rate cuts, and some people have talked about high 3, low 4% is where they end up, what do you do with your duration? Where do you want to have your bonds? What sort of longevity are you looking for in the holdings?
Sure. I think bonds finally give you income. So I joke that fixed income finally has income in it, which is good. Real income. Not only are you getting that nominal income, but net of inflation, you're actually earning real returns. The other thing bonds are giving you is diversification, which you talked about 22. It was the opposite of diversification because risk assets struggled and bonds struggled. That's changed. And actually, you don't have to take my word for it. Look at the last couple of months, just the last two payroll reports that come in a little weaker than before. And this fear of a hard landing or a recession starts to come up. Risk assets struggle and bonds do really well. So when you talk about a longer term perspective, I think there's a lot of talk that's been that has happened that 60-40 is dead. No, 60-40 is back because that fixed income component is giving you that diversification. So we've actually been adding to, because we're in a soft landing, we have risk assets in the form of spread, high quality investment grade, high yield spread, securitized spread. Owning some duration is a good hedge. If the economy starts to slow down, our spread products will underperform, but then that treasury long, and we're long intermediate. I think the 2-year doesn't give you that much. You start to go long 5s and 10s. We should not worry that much about whether they go 25 or 50. Let's look at the totality of cuts.
Where they end up.
Exactly. Where they end up is right around 3%. We're not pricing in a recession. So if we do get into a recession, at that point, the Fed's cutting to 2%, 1%. There's a lot of room in terms of price appreciation for that duration. So I like adding duration. We're buying any backups. Any election related, you talked about elections, so I bring that up. Any election related volatility, supply and auction that doesn't go well. Anytime interest rates rise, I think it should be viewed as a buying opportunity to add that duration, especially if you've got risk assets on the other side of your portfolio.